So, welcome to Options. This is the second in our three-part series. This is going to cover intermediate strategies. Normally, the beginners or basics and the advanced one, which we'll hold again next week. It's a recurring series. We do it every 3 weeks. We just keep rotating it. Those last for about an hour. This one is going to last a little bit longer than that. I appreciate your patience with me. I'll tell you exactly how it's going to go down. We're going to first talk about some Greeks, implied volatility, bid-ask spread, things like that. And then we are going to get into practical sort of applications. What does a vertical look like, whether it's a debit or a credit for a call or a put? But the first half hour, 45 minutes, I really spend on trying to hammer out as much as I can from the Greeks. Yes, it can be like drinking from a fire hose. All right? It's the old saying, you eat the elephant one bite at a time. So let's start. Actually, before we start, nothing I say is to be taken as advice. It is strictly educational, and please consult your advisor. Options are risky. I'll say that. Me. So a little bit about my background. I have been coached by some very impressive people. I've been blessed to be able to have that experience. And my job here is to just pass along what I've learned to Chaikin Analytics subscribers and help them pair the power of the Chaikin Analytics platform with the power of options. So that is my goal and my job. We're going to do, again, a quick review of stuff we did last week in the basics. Then we're going to talk about implied volatility, liquidity in the Greeks, and finally, single directional options and vertical spreads, credits, and debits. Quick review. These are our 4 basic actions. Today we're going to talk about each one of these individually, and we're also going to talk about combining calls, both a buy and a sell, and puts, both a buy and a sell. They're known as verticals. So we're going to talk about those, but just remember, these are the only 4 actions that you can really take in the market, and all the complex stuff they talk about are just a combination of these, all right? If you buy, you have the rights, and if you sell, you have obligations. Buyers have rights, sellers have obligations. Generally speaking, when you are long, when you buy, you have higher reward and lower risk, and for that higher reward and lower risk, you have lower odds of success. The inverse of that is then true for when you are a writer of options, or you sell them, or are otherwise known as short. So short, aka selling, aka a writer of options. Those are all same things. They tend to be lower reward, higher risk, but higher odds. Now, there are ways that you can pull on these levers. So you can be a short options and give yourself less risk and more reward. Your odds then are going to change slightly. These reward, risk, and odds I like to think of as levers in the options market. And when you push one or pull on one, it automatically moves the others. I can't just push the reward up and the risk down and the odds up. It doesn't work like that. All right. When you pull the odds down, you tend to get lower risk and higher reward, but you can't get highest reward, very, very little risk, and highest odds. When we are buying, the premium is something that we have to overcome. So on the left, we have a long call example. On the right, a short call example. I created these little images here. This is not exactly how it would look on your screen, but you can see here we have same strike. This would be for the same thing. This would be someone who bought the call and someone who sold the call. This would be what their break-evens look like. Right? Both of them have a strike of 242. Same strike. These images are not quite aligned. Both of them have a premium here. Now, on the long call, the premium is the risk. On the short call, it is the reward. And at the point, the exact point where the buyer's risk turns into profits, the seller's reward turns into losses. That's the break-even line, and it is similar. It is the same for both of these people. In fact, it is a zero-sum game. If the person who sells the call is losing money, then the person who bought that same call is gaining money, and vice versa. It is a zero-sum game. Now, you're most likely going to see this concept represented in this way. These are P&L charts, option profit and loss graphs. Along the x-axis, the horizontal axis, as we go here, that is the stock price, the underlying stock price. To the left means the stock is going down. To the right means the stock is going up. I put the same long call and short call example, well, not exactly the same, but close to it. This is just this. We've just converted them to what you see in options play. Now, options play gives you this middle line, which is current stock price. A lot of times you'll see that line along the edge here. And it's not the current price. It's just the line that they use to designate the y-axis. Options play puts it in the middle at current price. You'll see the break-even point right here. On the long call, we lose money, but it's fixed. At some point, we stop losing it, and we just flatline on our losses no matter how low the price goes. That loss here is equal to that gain there. These are the same things. And this gain here is that loss there. These are the same things. The curved line takes into account time and volatility. The angled lines, the ones that are not curved, these are what your profit and loss would be at expiration. And the curved line takes into account time. All right. So that is, you'll see a lot of those profit loss charts. Oops. No, this is just for the put. So the put, same thing, we just flip it around. For the put, again, strike 242, the person who buys it pays the premium. That's the amount of money they have to overcome in order to break even. You'll see the break even numbers are exactly the same. Again, zero-sum game. On the short put, they take in the premium. That's their maximum reward. And their risk is if it keeps dropping all the way down to zero, which is a big risk for that little reward. Now, their odds are higher. Their odds of success are just higher. How does that look here? Again, it's just the inverse of the call. The owner of the put, this is their risk. It's fixed. That corresponds to the person who sold it. They get that right up front. That's their reward. A put is bearish, so as the price goes down or to the left, pardon me, as price goes down or to the left, we get more profits on this side and more losses on the short side. All right, let's get into an options chain. A lot of numbers on this thing. Let's start right with the middle. Right down the center is where the strike is. Now, I pulled this off of my Fidelity account, but it's similar. So these actions are something that Fidelity has in theirs. But really what I'm looking at are the strikes. The strikes are listed right down in the middle. I've got calls on the left. I've got puts on the right. I know that without the things there because it is shaded to show me what is in the money. So I can see this is what's in the money. These are shaded. This is common amongst brokerages, which means that the stock price is somewhere right in here, right in between there. If these numbers are in the money over here, that means that they're lower than current price. This must be the call side. Let's just go through some of the columns that you're likely to see. So last is last price, and the change is just how much it's changed. That's same as with your stocks. The bid and the ask is the difference between the buyer and the seller. The bid is what the buyer says. Think about like buying a home. I will bid this much for that home. And the seller asks. They say, no, I'm asking this much. And when they come to an agreement, then a trade happens. Now, You'll see some of these have what's known as a spread, a difference between them. In this case, there's a 2-penny spread there. Some of them only have a 1-penny spread. This is the SPY option chain. It's really, really liquid, has very, very tight spreads. You won't always see it like this. We'll talk about spreads again in a few minutes. Then we have volume and open interest. We'll talk about that again soon. Our implied volatility and our deltas. All right. You'll see the deltas are negative for the puts, positive for the calls. We're going to talk about that again in a second as well. Let's talk about open interest and volume. So first, open interest is a measure of previous activity. It tells us how many contracts have already exchanged hands, how many active contracts are out there, how many people have bought and sold contracts since this contract has existed. Volume refers to what has happened today, its current activities. How many of those how many contracts have changed hands today? So your open interest will reflect the volume. Your volume will not reflect open interest. And that's why they're listed differently. Normally, the lower the open interest and the lower the volume, the less liquid a stock or an option tends to be, which means you have risk of being able to get in and get out easily. Because if you own something and you want to sell it, you don't just sell it into the ether. There's someone on the other side. We need somebody on the other side of that. So open interest gives us a sense of how many people out there are willing to take the other side of this or have taken the other side of this previously. Volume tells you today. Okay. Bid-ask spread is the difference, as I said, between the buyer's price, the bid, and the seller's price, the ask. For new traders, you want definitely for new traders and to lower your risk, you want to be with things with tighter bid-ask spreads. Generally speaking, you want to be with tighter bid-ask spreads. What I encourage people to do to start is to only be in options where the bid-ask spread is no larger than 10% of the ask. So if the bid is $1 and the ask is 90 cents, then we have a spread of 10 cents. The difference between the bid and the ask is the spread. Now, the spread divided by the ask, I want it to be less than 10%. In this example, we would take our 10-cent spread, divide it by our dollar ask, and we would get 0.1 or 10%. No, not $10, 10%, which would be acceptable. All right. If the bid was $1 and the ask was 80 cents, we'd have a 20-cent spread. Then that'd be 20% wide. If it were, let's say, let's just do this math. Maybe it's I don't know, $1.50 by $1.20. That gives us a spread of 30 cents. So then I'm going to see my spread of 30 cents over my $1.50, and that is 20%, which would not be acceptable. For at least for new people, it would be far more risky. The wider the spread, the more the risk that you're not going to be able to get out at the mid price, and you're going to be stuck on the most disadvantaged price to you. So if you own it, you'd be stuck selling it at the bid, and if you sold it, then you'd be stuck buying it at the ask. So just certain, what is BDs? I'm sorry, I don't get that in this context, Stephen. And I'll get to the delta question in a second. So that is how I look at bid-ask spread. I want the spread to be less than 10% of the total, the bid-ask spread to be less than 10% of the ask on what you're looking at. Let's talk about implied volatility. This is an important concept, and I hear a lot of people say, well, volatility is really, really, really low, and they are using the VIX as a measure. The VIX is a very specific volatility index. It measures volatility on a very specific financial asset, the S&P futures contract, and a specific set of S&P futures contracts. So it is not necessarily a good representation of what the implied volatility is on Facebook or on Amazon or on AT&T. It's really only good to tell you what the general overall volatility is on the index itself. When we look at implied volatility, we want to look at implied volatility on individual equities and understand what they are for individual equities. Implied volatility can tell us if an individual equity is currently trading at the upper end of its volatility range or at the lower end of its volatility range, which becomes very important when we talk about Vega, which is a Greek we will get to in a second. Now, the implied volatility also gives us a clue as to how far the market is pricing in a move. So implied volatility can help us calculate the expected move of a stock, which typically is one standard deviation or thereabouts for you statistical folks out there. All right. Now, one of the things I like to do with implied volatility is, before we get to the expected move, I look at implied volatility against historic volatility. Because, as I said earlier, each stock has its own implied volatility fingerprint, its own unique implied volatility, and they're all going to be different. And so if you told me, hey, I've got this stock, XYZ company, and its implied volatility is 50, well, I would say that is what, and I forget the comedian who came up with this, I think it was George Carlin, but that is what we call a half score. That's like telling me that the Yankees scored 3 runs. It doesn't really tell me enough context to know if that's good for the Yankees or bad for the Yankees. So if you told me the implied volatility on stock XYZ is 50, I would say, okay, but what's its normal range? Because if the stock's normal volatility range is 10 to 50, well then, that's pretty high implied volatility, isn't it? It's all the way at the upper end of its range. But if you tell me that its implied volatility range is 50 to 100, well, now that same 50 has a different context. That 50 is actually pretty low. It's on the lower end of that stock's volatility range, which would mean it would be likely to rise. The volatility more likely to rise to the lower end of its normal range. And so what I like to do is I like to use implied volatility and measure it against a stock's historic volatility. You can do this in a number of ways. I know that Thinkorswim has something called IV percentile rank. I don't know exactly how they calculate that. You'll have to ask Thinkorswim. I get asked that a lot. You'll have to ask Thinkorswim. I like to use a measure called 30-day historic volatility. So what I do is I take 30-day historic volatility, and I have this on my Fidelity. Other platforms have it. You can use the implied volatility, 52-week high and low, if you just want to look at implied volatility. I happen to use 30-day historic volatility. If I can get the 26-week range, I like to use that, but I've been generally using the 52-week range because that's what Fidelity's had, and I like it. And this is really to keep me away from terrible trades. Okay, so this is what I do, 32, 52-week range. Let's just say, for example, it is 10 to 50. That is what the 30-day HV has been, between 10 and 50. Then I look at current implied volatility. And if current implied volatility is in the lower, maybe third, only debits. If in the upper third, I only do credit trades. Now, why is that? Well, implied volatility is a mean reverting feature, function. So if we have a volatility that's doing this, we get the range of it here now, right? This is the low end of the range. Here's the high end of the range. We don't want to be buying when it's up in the upper end of the range, because what's likely to happen is the volatility is likely to decrease. And when the volatility decreases, it lowers your premiums. It brings the premiums down. And if we're long, we don't want that. Now, if we're short, that's great. Oops, I didn't finish writing out my only credits. This should say only credits there. I don't know why that got cut off. All right. If it is in the bottom third, well, that's okay because I didn't mean for the whole thing to go. We want to buy then because then we expect implied volatility to rise, and rising implied volatility is positive for us. Okay, so we're going to get back to that in a minute. When I talk about Vega, it'll become more clear as to why I do it that way. But basically, I look at the 30-day historic volatility range. You could look at the IV's own 52-week range, whatever it is. I calculate the range and I figure out what is the top third of the range and bottom third of the range. If you want to be a little more aggressive, you could tighten it to the outer quarters. Okay. In the middle, I rely on other things to decide whether or not I'm going to buy or be a net buyer or a net seller, do a debit or credit trade. Now, we can also use this to to calculate our expected moves. They do this for us in options play. They help us calculate the expected move. It's all there. But this is a quick calc. And I used this right here as my example. So I pulled this off of here. That's my example. So to do a quick calculation, what we do is we take the implied volatility, which is 7%, and we multiply it by the strike, which in this case is 242. All right, so there's the implied volatility, and we multiply it by the strike. And then we divide that by the square root of the time left. So I'm just going to say there's 16 days left because that makes it easy. So we take that number, 1694, and we divide it by 4. That gives us our expected move. Now, this expected move does not mean higher because it's a call. This is what we call a plus minus, which means we can then calculate that the 242 strike, we're expecting, it's pricing in a move to 246.23. How did I get that? So I take the strike, 242, and then I add, the expected move, which is 4.23. We're just going to truncate it. And that tells me that the if the SPY goes up, it is likely to go to 246.23. But this is a plus minus, so it could also, the expected move, it's also pricing an expected move down to I have to do some quick math in my head here, but 237.77. That right there is the likely range that this implied volatility is pricing in for the 242 strike. So it's a way to do a quick calc. You take the implied volatility, you multiply it by the strike, then you divide it by the square root of how much time is left. It tells you what the implied move is. Usually it's about a 1 standard deviation move, and they list it for you in options play. So I don't actually ever do this calculation. I look at what options play says. But I used to scribble it on paper. So let's talk about the Greeks. The Greeks, and not Aristotle. So delta, theta, vega, gamma, and rho. Options are priced on what's known as the Black-Scholes model. We are not going to, I couldn't rattle off what that equation is. It's a statistical equation. You can go Google it, but these are the moving parts inside of that equation. Delta tells us how much a premium is going to move based on the stock's movement. Theta is our rate of time decay. Vega tells us how much the premium will move when implied volatility moves. Very important. That's why we look at implied volatility to assess whether or not we should be buyers or sellers, because it's going to affect it, and Vega tells us how much. Gamma tells us how much delta is going to change when the underlying equity moves $1. And rho, this is the last you'll hear me talk about this really, is the premium change for a 1% rise in interest rates. Now, if you're buying leaps, that might affect you. However, it's going to affect all options on the same duration equally, and I don't really anticipate interest rate rises or falls. It's not part of my process. And so I don't really consider rho, honestly. When I'm thinking about, well, do I want to buy or sell this option? I don't think, well, what are interest rates going to do? And how's that going to affect this option? It's not at all part of any calculation I do. The other ones, though, I do look at. Let's talk about delta. Delta ranges really from 0 to 1 and 0 to -1. So long calls have positive delta, long puts have negative delta. So really ranges from 0 to 1 and 0 to -1. And it tells us how much our premium is going to rise when the stock rises or falls $1. So long calls have positive delta because long calls are bullish, and if the stock goes up, the premium will go up. So it's a positive relationship. Puts have negative delta because if the stock goes up, puts are bearish bets, so they actually will lose money. Premium will go down. So in this case, if the stock is at 10 and the premium is 1, the delta is a half. When the stock goes to 11, the premium will rise to 150. All right, because we have a stock price at 10, the delta tells us how much it's going to rise if the stock goes up $1. In this case, it's telling us it's going to go up 50 cents. Our premium is $1, delta is 0.5. We go up $1 on the price. There we go. So if the stock rises to 12, then the premium will go up to 2, another 50 cents. Now, it won't work linearly like that. And when we get to gamma, we'll see how gamma affects it. But delta tells us generally how far up or down we go, which gets us to Stephen's question, which is why doesn't Chaikin promote buying options with a high delta as a stock replacement? To be perfectly honest, we don't really promote any buying or selling options. What we want to do is help people understand what option strategies are appropriate for what. So if you want to do a stock replacement strategy with a very, very high delta, that's fine. Options play has defaults, and the defaults do not take one strategy over another, even if it has a higher score. That is to say, you could set up an options play selling a put with a delta of 0.01, and options play will give that a score of 250. But that doesn't mean that that's what they're going to put up as their default, because that's not really, an option strategy that a ton of people are going to do or be interested in. So they put forward buying 100 shares, buying a call, or buying a call vertical. They also go one strike in the money on the debit legs and 1 month out in time, at least a month out in time, which is why we're looking at November's on options play now and not October's. They're looking not at the front month, the next month. There are ways to do high delta stock replacements. You can do what's called a poor man's covered call, those sort of things. I talk about that in the advanced option strategies class. BD, broker dealers. It just occurred to me what that stands for trading options. I use Fidelity. I also use Thinkorswim. I don't really have a recommendation. I really like the ones I use. Thinkorswim is pretty good in terms of order entry and some analytic tools that they have. But I don't really have a recommendation. I know that TradeStation has improved their experience a lot. I know we have a lot of people that use Interactive Brokers as well. Doe has a new one, which is the Tasty Trade folks. Yes, so I don't really have a recommendation for a broker dealer that's more user friendly. Yeah, I'm sorry. I wish I did have a better one. I happen to like the ones I use, which are Thinkorswim and Fidelity. All right, so that's delta. Theta. Theta is not a constant. Theta is your rate of time decay. It's measured in dollars per day. And every day, options lose value. They have a time decay in it. The extrinsic value is subject to time decay. Intrinsic value is not. Extrinsic value is subject to time decay. But it is not a straight line. So as we approach expiration, right here, we'll call that expiration, time decay does not just kind of move down like this, right? Time decay is curved, and it looks more like, I'm not a great drawer, so something like that. It really starts to fall off in the last 30 days, and it accelerates as we get closer. So the last 2 weeks will lose more time decay than the second 2 weeks. So when you have a month left, week 4 and week 3 will lose less time than week 2 and week 1. And when you have 1 day left, that last day is going to have a greater theta loss than when there's only 2 days left. It accelerates as we get closer to expiration. It's really not that impactful when you go farther out in time. It flatlines pretty much. It's there, but it's not very measurable. This is one of the reasons why I encourage people who are credit traders to stick to credit trades that are on the shorter time durations, say 20 to 45 days, something like that, because that's where you get the most time decay, and time decay is a benefit to a credit trader. It's also why I encourage debit traders to go out in time a little more when they're doing their debit trades, because then your whole trade can take place without you even having to feel the worst effects of time decay. Remember, time decay is like wax to a flame. The closer you bring it to the flame, the quicker it is going to melt. And the expiration date, that is the flame. Again, it's negative for long options. It's positive for short options. It helps us when we are short. That is theta. Vega. Vega tells us how much our premium is going to move based on implied volatility. As implied volatility rises, Vega causes our price in the option to rise. Long options have positive Vega. This is why when I talked about the exercise I do with implied volatility and historic volatility, I only want to be a buyer when implied volatility is relatively low. Because when that implied volatility rises, as a buyer, as long options, my premium is going to go up. Right? The longer in time we go, the farther out in time we go, typically the higher the Vega is. Why is that? Well, suppose I said to you, Apple is likely to move, I don't know, let's say $1 today. Right? That's a reasonable thing for me to say. It's reasonable for me to guess that Apple might move $1 today. I might say in a week it might fluctuate $3 up or down. In a month, maybe it fluctuates 5. You see, the fluctuation that we can expect gets larger the longer out in time we go. In a year, would it be reasonable that Apple might fluctuate $30? Yeah, absolutely. Is it reasonable to expect it to fluctuate tomorrow or by Friday, $30? No. So the Vega is going to be shorter, smaller, on shorter durations. It's also going to be less as you go in or out of the money. Vega is highest at the money. And we're more sensitive the farther out in time we go. Okay? As you go farther in the money or out of the money, you get lower Vegas. At the money has the highest Vega. Okay. Gamma, also largest at the money. It gets smaller as you go farther in or farther out of the money. Gamma tells us how much delta is going to move. So let's go back to that example I used where we had a stock price of $10, a premium of 1, and a delta of 5. Oops. All right, so stock price is 10. Our premium is $1. Our current delta is, we're going to use 0.5. And let's say our gamma is just 0.1. When the stock price goes to 11, our premium will go to $1.50. And our delta will now be 0.6. Because gamma says if we go up $1, delta is going to go up 0.1. We're going to assume that our gamma stays constant. It fluctuates a little bit, but not a ton. So we still have a gamma of 0.1. So now if the stock price goes to 12, our premium is now 210. Because now our delta says we're going up 60 cents. And our delta is no longer 0.6. Our delta is now 0.7. And so the new premium would be 280. The delta would then go to 0.8, so on and so forth. So that is gamma. All right. Let's start talking about calls, puts, buying and selling them. Let's get into the sort of the nitty gritty here, the application of them. You can see I put up in the money, at the money, and out of the money. These were SPY on the ETF SPY. I did these back when I created these slides a while ago. So I probably should upgrade them, but it gives me a sense, it gives you all a sense of what you're likely to see. As I said before, you have risk, reward, and probability of profits are some of the levers that you're going to be able to fill. So right here, as a buyer, the cost is our risk. And you can see at the money has the middle amount. As we go in the money, the cost and risk gets higher. As we go out of the money, the cost and therefore risk gets lower. Now, for that, the probability of profit, POP stands for probability of profit, changes. The in the money higher delta is going to have a better probability of profit. That's because its break-even number is going to be lower. It has less intrinsic value, so it's quicker to get to. The at the money one is going to have the middle amount of probability of profit, And then the one out of the money is going to have the smallest probability of profit, the lowest delta, and the highest break even. And that's how it works. You can risk less, but have less odds of success and need the stock to move more for you to get to your break even number. Or you can risk more, have higher odds of success, and a lower break even point. And so it becomes a balance for individuals. And I talk through this with individuals all the time, what you're going to be more comfortable doing. Not everybody's comfortable going in the money or deep in the money. Not everybody wants to use options as a stock replacement. Some people just want to do very, very, very low risk, very low probability earnings trades with options. There's all kinds. Options give you options. There's a lot of different things you can use options for. And so understanding how to match the appropriate option strategy with what you're trying to achieve and your risk tolerance is key. My job is partially to educate you on what are your odds of success and what are the risks and rewards for any given option strategy, and then to help you match the appropriate one with what you're trying to achieve. You can see at the bottom here, and all this is pulled right from options play, but you can see here the delta in the money is bigger than the delta at the money. At the money deltas typically are 50, out of the money, lowest delta. You can also see that your gamma and vega are highest at the money, and they get lower as we go deeper in or farther out of the money. A long call. So this is kind of the setup, and I know these are just clips that I took right off the platform, and this is sort of the ideal setup. But the general best practices are you want bullish money flow. I don't need it to be green right in that moment necessarily, but I want to see that it's been more green than red over the past few months. Oops. Next, we don't want it overbought. When stocks are overbought, they tend to have bits of pullbacks. And if you buy when they're overbought, I'm sorry, everybody, I keep bumping the little scroll wheel and my mouse button. Sensitive technology. When you buy when it's overbought, it's likely to have a pullback, and you're better off for timing purposes trying to catch it. I personally, because people ask me all this time what I do, I want it to be oversold. I don't care if it's right here at the very beginning of oversold, all the way at the bottom, or just as it's exiting. I just want it to be under the 30 line. That's me. Some people want to wait till it's kind of curling up and heading up a little bit. That's also fine. That's a great place to do buy rights and things like that, or short, small move option trades. You can get half the move or 2/3 of the move that way. Getting in down here is a little bit riskier. It might keep going against you. Again, it's a balance, but you do want it to have positive relative strength and ideally a bullish power gauge as well. Then you don't want to get in when the price is at the upper band. Just like you don't want to get in when it's overbought, when price is at the upper band, it tends to pull back from the upper band. I try personally to get in when we are below this middle line, or at least at it, right? So I might get in right there if I really, really like this trade. But I try to get in at or below that middle line in a bullish setup while we're oversold. That's how I like to do it. But ideally, just don't do it when we're overbought or up against the upper band. You tend to get pullbacks off of that. And that's for a long call. A long put, we're going to look for exactly the opposite. It has the same basics. The cost of the in the money is going to be greater than the one at the money, which is going to be greater than the one out of the money. For that change in cost and therefore change in risk to the debit trader, we get a difference of break-evens and probabilities. The in the money trader is going to have a lower break-even and higher probability for their bigger risk, whereas the out of the money is going to have the lowest probability and the higher break-even number, but lower risk. They can only possibly lose $120, whereas the in the money trader could lose more than 3 times that. What does one of the best practices for puts? Puts are bearish. So of course we want a bearish power gauge rating and poor relative strength. In this case, we don't want it oversold, and we don't want it at the lower band. Again, typically when things are oversold, they're going to move up, and when they're at the lower band, they're going to bounce. And so that's not the ideal timing. I try to catch it when it's overbought, and again, above the middle line. That's when I like to enter these, when we have poor money flow. Again, you can get in here. I don't think there's anything wrong with that, getting in here. I like to use the lower band as my target, or maybe even slightly below the lower band. In these bands, in uptrends, or well, in downtrends, I expect the band right? We're in a downtrend, so I expect the bands to keep going down, which means if I'm getting in and I'm looking at a target, so if I'm getting in here and I'm looking at a target toward the lower band, well, I go a little bit below the lower band because I expect the lower band to drop and price to get to the lower band. I'm trying to skate to where I think price is going. So that's what I look for in terms of a single put. Personally, just to go back to just the long call and long put, if I'm doing a single long call or long put, I generally like to go out in time, 60 days or more, 60 to 90 days, and I generally like to go in the money, right? That's how I like to set up my long singles. So in like a long, let's just go back a second, in a long put, in this sort of scenario, again, my personal entries that I like to do are when we are overbought to some extent. Doesn't matter where, it could be here, could be there, could be anywhere along there, overbought and above the middle line. Then what I'm going to do is I'm going to go look at the premiums, and if I like them, I'm going to go in the money. So I might buy the 32 or the 33 put. And I'm going to then have a target somewhere down here, and I'm going to go out 60 days, usually at a minimum. What I like to do if I'm buying options, I like to buy one more month than I think it's going to take, for two reasons. I don't know if this has ever happened to you, but if you trade options for a while, I'm sure it will. You'll buy an option and it'll go sideways. And maybe you have 2 months on the option and you expect the move to take 2 months. And so you sit there waiting for the move to happen. You go sideways for 2 months. And then expiration comes up and you go nuts. All right, didn't happen. The very next day, the stock takes off, right? The stock will always tend to take a little bit longer than you think. So when I'm trying to estimate how long I think it's going to take, I add a month. Give myself some time. I'm buying time to be right. Secondly, back to our theta conversation, the worst parts of the time decay are in that last month. So if I think it's going to take 2 months for this trade to play out, I buy 3, and then I close my trade when it plays out, when there's a month left, and then I don't have to deal with time decay at its very worst. I can get out of the trade. There's nothing that says you have to hold that option until expiration or even close to it. I think that's one of the bigger problems people make, is they think that because they have until December 17th, that they should wait until December 17th. If you made the profits you're looking for, great. If that happens in a month, you don't have to wait till December. Take your money. It's not your money till it's your money. You can't go to McDonald's and say, hey, I've got an option on the S&P and it is deep in the money now. Can I get a burger? Right? So just those thoughts. What deltas do I use for my singles? If I'm just doing a single, probably at least a 60, maybe a 65. If I'm trying to go farther out leaps, then I might go a little bit, especially if I'm going to do calendar spreads. I'll talk about that next week or the week or the third one, but I talk about calendar spreads in the advanced session. But usually, if just a single, I'm looking at a 60 delta at a minimum. That's me personally. It's my pleasure. Uh, Also, paper trading account. I know Thinkorswim has a paper trading account, so you can do it there. I think that's a good way to learn options is to take a few paper trades, or if it's not going to be too much an effect on your account, to take small option trades. One of the things that my colleague and I did was we took two options trades recently at two different expirations. So he's new to options, and so we're live, and I went in with him on it, learning how it price affects it when you go um, on two different expirations. We also did this on two different strikes. So we picked the same expiration for the same trade and then did one at the money and one in the money. And we're watching how the profit and loss works on those as it goes our way or not our way. So it's a great learning experience, but again, it's something that if you're going to do it with live money, make sure it's not an amount that's going to be um, emotional for you, so that it can really be a cheap live learning experience. If you can do it on paper trading, probably all the better. All right. Um, so there you go. Covered calls. We're not going to talk about naked calls, which is just selling a call without owning the stock, because that's an advanced strategy, requires the highest level of options permissions with your broker. A covered call is where you already own the shares and you sell a call against that asset that you already own. With covered calls and credits, I have a few things I like to do. One, I like to go out of the money. I like to have high odds of success, around 70% or higher. I've done them in the high 60, 65% even, but I really prefer 70% or higher. I look for an annualized yield. This does not meet my goals. I look for an annualized yield of like 10 to 12%. Sometimes I find the 15, 18 percenters, those pay for the ones that I go on that are only 8%. But I generally shoot for about a 12% annualized or 1% raw return. Now, if I'm doing this on 17 days, and this is, again, not enough for me, but if I'm doing this on 17 days and I can get a raw return of, 0.6% annualized, that's going to be 15%. And that would be fine. I look at it versus the amount of time I want it to take. Right. So out of the money, short durations. I usually sell my calls for 20 to 35 days, somewhere in that range. I got to say, Tony Zhang, options play guru, uh, is did a study. We did a webinar together from September 11th. You can look at it, but 21 to 35 days, I think, is the sweet spot for amount of time. Also, it means that theta is going to be working for you the entire time. Going farther out gets you more premiums. There's more. There are reasons why you'd want to do that. I talked to somebody yesterday. We're talking about covered call ideas, buy rights, which is where you buy the shares and then sell a call, and where to put that strike and how far out. Depends on how long you want the trade to take and how bad you want it to be taken away from you. So for a covered call, I want the price near the upper band. If I want to keep my shares, then I want to put the call when we're overbought, definitely not oversold. And it doesn't have to be overbought necessarily. I try to catch it when we're overbought and at the upper band, and then I go out of the money and sell my call. And I sell it for a shorter duration, hoping that the price will eventually drop and I can exit the trade and keep my shares, and then turn around and sell another one, short duration, hoping the price will drop, and then I can exit my trade. I buy back all of my shorts all the time, unless I want the shares, unless I really want to be put the shares, I should say. There is a caveat. But if I'm trading just for the premium, I buy back my shorts, always. I try to buy them back for about 20%. Sometimes I get more aggressive. I go for 10%. So that is to say, if I sell it for $1, I take in $1 premium, I am going to turn around as soon as it is filled, and I'm going to put in a good till cancel limit order to close that position to buy back that short option. If I sold it for $1, somewhere between 10 and 20 cents. For new options traders, you might want to go with 70% gain. So when there's only 30% premium left, you're going to have a higher win rate, although lower net dollars coming in, but a higher number of wins. I know there is the mindset out there because I hear it. There's only 3 days left. There's only a nickel left of the premium. I'll just let it expire worthless. Take the whole thing. Why bother buying it back for just a nickel? Well, at that point, the most you can make is a nickel. That's your maximum possible reward, is a nickel. And your risk is not only the profits you've already made, but giving them all back and then having losses. Because let's say tomorrow the company comes out and says, hey, we had a terrible data breach 6 months ago. And they do this on a Thursday. And your option is expiring on Friday. And now all of a sudden you're sitting on 100 Equifax shares that you had no interest in ever really holding. That's right. I'll use the cleaned up version of that, Spice. It's don't be a weenie for a teeny. Anyway, I encourage everybody to buy back their shorts. Buy back your shorts. That's what I encourage you to do. As soon as it gets filled, put it in a limit order, buy them back anywhere between 70 and 90% profit. So when there's only 10 to 30% back. You want to be more conservative, have a higher chance of success, do it toward the 70% gains. I know some guys that do it at 50%. That's great. If you're consistent and happy with that, great. Right? But don't just let your shorts sit out there, because you're going to end up taking hits that you don't want to somewhere along the way. And those hits are pricey. There you go. Those are all good. All good. What's next? Short puts. Same thing as covered calls again. At any shorts, what I just said, I apply that to any short position I have. Credit spreads, whether it's a spread or a single, whatever it is, buying back. Short puts, I try to do the exact same thing, honestly. I'm looking for the similar raw returns. I'm looking for the similar annualized returns. I like going out of the money with these as well. The closer to the money you get, the higher the premium you're going to get, but the lower probability of it expiring worthless. POW here stands for expiring worthless. I also like to do these on short durations. A short put is a bullish scenario. So we want to do these in bullish stocks with positive relative strength. We don't want to do them when we're overbought. That's going to lead for a drop in price. Short puts, we want these to rise, to go up. So I like to do my short puts when we are oversold, or at least close to it. Leaving is fine. That usually will tell me that the short-term bottom is in. I like to do these when we are at or below this middle line in the Chaikin bands. And I like to do these out of the money. I use these bands as kind of a strike finder for these puts. If you do it in between, again, you're going to get more premium, but you also risk more prices getting to it. These bands are really good at being at the range. I try to sell my puts at the lower band. Slightly inside of it, again, more premium, more aggressive. Slightly outside of it, less premium, but more conservative and higher odds of success. Again, I do it for short duration. I'm hoping that at the very least, or at the very worst, we hit the band and bounce. And then I get to keep my premium, not take the shares, and then do what they say in the market, rinse, repeat. So again, in nice bullish stocks, I like them to be oversold. At least, if at the very least, don't do it when it's overbought, and don't do it when we're at the upper band. One, you can get better premiums as it falls. For the same strike that you're looking to sell up here, you can get a better price for it when the stock is down a little bit, and you can sell the strike down here then. And you get higher odds of success, and you don't have to worry about it getting put to you. All right, so those are long calls, short calls, long puts, short puts. Let's talk about vertical spreads, and we'll wrap up on this. We'll spend the next 15, 20 minutes talking about this. I appreciate everybody hanging with me. Vertical spreads are where you buy and sell either calls or puts. So either you're buying a put and selling a put, or you're buying a call and selling a call. You're doing it for the same expiration, but at different strikes. The pros to this strategy are it reduces your risk. So you get less risk, you can leverage your money more. The cons are it caps your rewards. It lowers the amount, if it's a credit trade, that debit leg, it takes a chunk out of the credit you take in, but it reduces the overall risk. On the flip side, if you're doing a debit trade, that short leg caps the profits you can make at the short leg, but you take in a credit against your already debit price, lowering your cost, making it less overall risk. So same basic thing here. If you're buying a call spread, you're going to have a short call above current price, a long call closer to current price. I like to go in the money. This is kind of how you set it up. Let's go look at example of a vertical call spread. So we are going to buy, in this case, we're looking at buying July's 241 call. We're going to pay $320 for that because we're buying it. We paid for it. Now, if we were to sell the 245 at the same time for both for July, right? Both for the SPY, both for the same number here, 1 and 1 for the same time, just different strikes, buy one, sell one, then we are going to reduce our original cost by $1.17. Think about that. Your cost, your $320 cost is going to be reduced by over 30%. You're reducing your risk by over 30% simply by selling the 245 call. Now, you're capping your profits at that 245 call. That's the downside. That's the trade-off. That's that lever we're pulling. We're lowering our risk. Well, the other lever that's going down is our reward lever. You know what lever's going up, though? Our odds of success. And this is why when you flip open options play, the vertical, I'm going to say 99.999% of the time. I haven't seen one yet. So if you happen to see one where the vertical has a lower score than the single, let me know. But generally speaking, that vertical is always going to have a higher score because it's going to have lower risk, typically a higher percentage gain, and higher odds of success. And so they score it higher for those reasons. Let's look at how this looks here. Again, we're buying a 241 call. We're going to pay $320 for that. We're then selling the 245 for $1.17. That means in the end, our net cost is $320 minus the $117, $203. Now, we've capped our profit at the 245 strike, which means our maximum reward is also capped. But so is our risk now. And for that, we get a higher probability of profit. So instead of risking 320 for unlimited potential, we're going to risk 203 for 197. I didn't mention this on when I talked about the debits, managing profits. You have to kind of decide where you want to take your profits. But when I'm looking at opportunities and thinking, is this a good opportunity for me? I look at what a 1 standard deviation or what my target is. I look at my target, and I want my target to be at least a reward equal to my risk, and really I prefer it to be 1.5 times. So this one, we're just going to say the risk is $200 and the reward is $200. That is a 1-to-1. For every dollar I'm risking, I have a chance to make $1. Risk $1, make $1. That's sort of the minimum that I will accept. I would rather it be risk 200 to make 300, which would be risk $1 to make $1.50. Now, that does not mean that I am going to wait until I've met that 100% gain to take profits. Okay, you have to have profit-taking rules. Part of it has to do with what the stock looks like. If I think it can keep running, I'm going to let my winner run as much as I can. I might lock in profits. I have different triggers for why I take profits and when. Okay, you should come up with similar guidelines for yourself so it's not emotional. So you don't think, oh, I'm up 100%, this thing's going to the moon, and then it turns around on you. If you have some profit rules, then you don't get greedy, and you can build rules to lock in profits and let winners run. Maybe when you're at 100% gain, you throw on a trailing stop or something like that, right? Or you just put in a hard stop so that you at least don't lose anymore. You at least make 50% or 75% or something like that. Different ways to do it. I'm happy to talk through with anybody who wants to talk with me about that. Just email me. Oop, let me just hold on. One other comment on here. You see our profit and loss graph up here. You'll see that again we have capped profits. One of the things I encourage people to do is, if the SPY were to get to 245 prior to expiration, when you get to that short leg, I encourage most people to just take whatever is in there. At that point, you're only going to profit off of the difference in time decay between the long leg and the short leg. That is, the short leg is going to decay faster than the long leg. All right. So once the SPY gets to 245 in this example, I'm going to take my profits. Maybe I let it run a little bit because the delta on one is going to be better than the delta on the short leg, and I can gain a little bit more, but it's really going to start to, the gains are going to really stop accelerating, and they're going to really start to flatline at some point. And at expiration, it's going to max. So if you get to the short leg of your vertical, I encourage people to just take their profits. Usually I have a mental stop yes for my vertical spreads. That is not uncommon, Spice, to have one loser wipe out 8 or 9 winners. That I think is something you might want to look at tighter risk. Maybe look for 50% losses or something like that to get cut out, and just keep it as a rule and see if that would help you. Low volatility environments are not great. You want to do shorts in high volatility environments. And again, it's a low volatility environment, quote unquote, because of the VIX. I'll tell you, lots of stocks out there have decent volatility inside of them. Volatilities are thumbprints, they're fingerprints, they're unique to each stock. All right, long call verticals. Much like a long call or a short put, a bullish, you want it to be, you want it to look like this. Now, part of what you're doing here is you're going to set up buy one, sell one. So I like to do it again. You heard me say how I like to do it. On these, you don't really need a high delta. The short leg is giving you the effect of going deeper in the money. So I really don't go deep in the money for something like this. I do go in the money, but only slightly in the money, maybe one strike in the money. And then I like to put my short leg at or just above the upper band. In a debit vertical, you want your short leg to be at your profit target. Don't get too greedy. Be reasonable. I like to use the upper band. That tells me what the expected range is. Maybe a little above it, you can also use the expected move. So there we go. That would be my vertical. Maybe buy the 135 and sell the, I don't know, 142 and a half. Right? A little more conservative would be maybe sell the 140 in this example. But that's how I like to set it up. Debit leg slightly in the money, credit leg at or above the upper band, and then out in time. Don't do these for 30 days. Do them for longer, unless you really think the move is only going to take a week. Okay? But I try to encourage people to buy more time. That doesn't mean you have to take the entire time. Just buy more time. It comes with more risk, though. So let's do a bearish call vertical. That is a credit spread. That is where we're going to sell the call just above current price and then buy one even higher, the one that's farther out of the money, right? So we sell one close to current price and then buy one farther away. We take in a premium for that, but we're not naked. If we just sold the call without owning the shares, we'd be what's called naked, and we'd have unlimited risk. This one that we buy helps us limit our risk. Now, here's the thing. We could have bought the 246 let's say, and only had a dollar wide spread. That would make our risk a lot less, but that would probably also make the premium we take in very, very little. Maybe we only take in 10 cents and our risk is 90, something like that. So how far away you put that long leg versus the short one depends on how much reward versus risk you want to take and what your odds of success are going to be. Typically, these have higher odds of success. I want them to be in the 70s or higher. I don't really have a risk reward rule for this one. In my debits, I want it to be at least a 1-to-1, preferably 1.5 to 1. So if I risk $1, I want a chance to make at least $1 or $1.50. Even if I don't plan on taking the full $1.50, I want a good, it's like a good stance, whether you're a golfer or a baseball player, you're going to get better odds of success and better chances of hitting it the way you want it and getting the hit that you want if you have a good stance off the bat. So I shoot for those sort of things because I consider that to be my initial setup stance, my shoulder square, that sort of thing. Doesn't mean I'm going to hit it well or get what I'm looking for, but I have better odds. For this, again, it's a bearish setup. You would sell the call closer to current price. I like to use the bands again as my strike finder. So selling the call inside the band is going to be a little more aggressive. Selling it at the band, I think, is optimal. But again, you're going to get more premium if you go in the band. And then you buy one farther out. How far you make that spread is up to you. Okay, you could do a spread 32, 33. You could do a spread that's going to give you probably more money, but lower odds of success, more aggressive. You could do a spread that's 33, 38, right? It's going to give you less money and more risk because the spread is wider. You have to determine what your comfort level is for that. You're welcome, Sybil. Thank you. I appreciate the feedback. So that is a short call vertical. Again, I do it on, yes, it is tougher, Spice, right now. Lower is tougher, but go find stocks with higher volatilities. They're out there. You might even be able to screen for them in something like, there might be volatility screeners out there that you can use to find them. I tend to look for the stocks with the good setups and then go look for the volatilities. You could do it the other way around. You could go look for the volatilities and then import that list into Chaikin and run it through to decide which side of the trade you want to take. Let's look at puts, verticals, and then we're going to call it a day. I thank you all for hanging with me. Oh, come on. So a bearish put vertical is a debit. In this case, we're putting the long leg, I like to go slightly in the money. The short leg, again, at our target. In this case, we bought with 370. We offset it by 211. That's pretty good. And you'll see then our risk is $1.59 for 341. That's almost that's more than a 2-to-1. For every dollar I'm risking, my maximum potential reward is almost $2 more. So risk $1.50, make $3, that sort of thing. I really like the risk reward on something like this. The POP is okay. On my debit verticals, minimum 40%, absolute minimum 40%. I prefer to be above 45. I didn't mention this for the singles. For my singles, minimum 35%. I prefer it to be above 40. And again, I like to go farther out in time. 50, 60, 75 days, something like that. For a put vertical bearish, we want to look at having bearish power gauge, poor relative strength. We don't want it oversold. If anything, we want it close to or near overbought with poor money flow. Again, we don't want it near the lower band. We want to have room to run. Lower band is our likely bottom end of the range. So we want it to be somewhere close to the middle line. I like to do it higher than the middle line. In a debit, again, I like to go slightly in the money. And then usually near the lower band for my target. So maybe there's a 29 strike here that I would like, something like that. There's my debit vertical. When the price gets to that strike, I'm out. No more. Gone. Poof. take my profits. Rinse, repeat. For a short, a bullish put vertical. In a bullish put vertical, this is where you're taking in a credit. Again, I want to have a higher probability of profit. Where you put the strikes, it depends on what kind of risk reward you want. All right, this one has a risk of about 55 for 245. You're going to risk $5 to make $1. Right, we make 55 bucks, but we have 5 times the amount in risk. But for that, we have a chance, 3 out of 4, of being right on this. Just statistically speaking, that POP does not take into account any of the Chaikin analytics indicators. It is strictly a statistical measure. The put vertical, short put vertical, is a bullish strategy. You're selling a put close to current price and then buying one farther away. That's how we cap our risk. Also lowers our reward. In this case, I like to do it, as I said, somewhere near oversold, out of the money. So aggressive would be, closer to stock price. More conservative would be if we go, I like to, again, go at the lower band. Very conservative would be outside of the lower band. When we sell, wherever we sell it, I'm just going to do it at the lower band. Then we go looking to buy one lower. What we're hoping for is that price doesn't go any lower than that strike, bounces, and then we can take our profits. Even better would be if price just does one of these and doesn't ever go down. That'd be great for our put verticals. Okay, so that's how I like to set these up. Short duration, 30 days, somewhere plus or minus a week, let's say. Out of the money, lower delta. So that is quite the session. We hung out for about an hour and 15 minutes, so I appreciate everybody hanging out and listening. I hope you enjoyed it. I hope it was informational, educational, and helpful to you. Do I add to my positions if it's moving in my direction? No. Sometimes I'll add to it if it's moving against me. But usually I take my position, and the only thing I'm going to do from there is either take my profits or cut my losses. I don't usually add or subtract to an options position, generally speaking. I don't usually add or subtract to a stock position either if it is moving against me. So yes, I saw the email. I had to do this first, though. Had to take care of this first. I'll reply to your email. In fact, anybody who wants to ask me questions, send me an email, just like Mr. Hoffman did regarding calendar spreads, in which I'm going to send a link to my last conversation on them to him. But you can send an email to us, support@chaikinanalytics.com. Just put options question in the title, and I will get it. I will see it. I will get it. And if I don't see it, somebody else on the team will see it, and they'll say, hey, Josh, there's a calendar spread question for you. And I will go, yippee, because I love talking about options. Or you can call us as well, toll free. There's the number. The next session is going to be advanced, and it's going to be October 11th. And I wish I knew off the top of my head which advanced it's going to be. We've broken the advanced up into 2 parts at the moment. We do non-directionals in one, and we do calendar spreads and big directionals like straddles and strangles in the other. We do like butterflies and iron condors in one, and we do ratio spreads and calendars in the other. And I forget which one's next week. I'm sorry, everybody. But I thank you for being here, and I look forward to your questions in my info box and voicemail. Be well, everybody. Oh, this is this is being recorded and will be up in a couple of hours. Okay? All right. Be well, everybody.